Hello and welcome to Any Answers Answered for October 2022. As ever, Tim and I have chosen two questions from the pages of Any Answers to have a look at. And the first one this month, Tim, is from the very straightforwardly named Manchester Man. And Manchester Man has a question about loans to a related company that's been written off. The question is, the company related to the other company, Company A, owned by the husband, makes a loan to Company B, owned 50 by the husband and wife each. And 3 years later, Company A, the one owned exclusively by the husband, wants to write off the loan. And the Manchester Man is thinking that the neutral tax treatment won't apply as the companies are not controlled by the same person. Am I right in thinking that? And do I need to change shareholdings to get around it? Tim, what do you think?
I think it is a problem. And let's start by going back to basics. If the husband owns 100% of Company A, and the husband and wife each own 50% of Company B, then we would ordinarily say that those two companies are connected, or in a different context, are associated companies. So for a lot of the tax legislation that we're used to talking about, those two companies look as though they are connected because the wife's holding in Company B could be attributed to her husband, and that would treat him as controlling both companies. But the first point to make is that under Section 466 of the Corporation Tax Act 2009, which then refers to Section 472 of the same Act, the definition of companies being connected for the purposes of the loan relationship legislation is in fact different from the definition that we're more familiar with from Section 1316, I think, or 1272 CTA 2010. So it's all a bit important. It's very important to know which definition of connected we're talking about. And the original poster of this question is absolutely right because of the holdings. And because for this purpose, the wife's shares are not attributable to her husband, he is treated as controlling Company A, but not treated as controlling Company B. And that means that the neutral tax treatment of such a loan being forgiven would not apply. And we're then told in the series of postings that Company A is a successful trading company that has built up significant cash reserves. Company B was set up by the husband and wife as a NewCo property company. They wanted to invest in rental properties, and Company B was set up for that purpose. And rather than take money out of Company A to finance, and it was 400,000 the amount of this loan, rather than taking the money out of Company A to finance the properties, taking the money out, of course, would have triggered one way or another tax liabilities. They thought, well, the easy thing to do is just have an intercompany loan, and that meant that Company B was set up and had that loan. But now, several years later, they recognise the loan's never going to be repaid, so can we not just forgive it? Well, I'm afraid the answer is that it would be subject to a tax charge in Company B, and that's what they want to avoid. Well, the suggestion of changing the shareholdings is one that could result in the neutral tax treatment that they're after, but one of the posters does make the point that this could give rise to other difficulties, either under the employment-related securities legislation, although the wife's no longer an employee of Company A, or it could be under the distribution rules. So quite a tricky area, but a good example of how you can get caught up in unanticipated tax consequences when trying to do a bit of tax engineering for a different purpose.
Far from straightforward. Our second post this time is from Miss Accounting. And Miss Accounting has a question relating to the 60-day capital gains tax return. And the heading itself says no tax due. So I already feel quite confident about what my answer is going to be. A client has sold a buy-to-let property and they have made a £200 gain. No other disposals in the year. Is there any mechanism to inform the revenue that the CGT return isn't due? And Miss Accounting is saying the disposal does need to be included on the tax return as the proceeds exceed 4 times the annual allowance. What does the revenue use to determine if a fine is sent out or not. This is the first one I've dealt with, says Miss Accounting. So Tim, how can you help Miss Accounting?
Well, a simple answer to the question is that the revenue would normally at the moment only determine that a penalty is due once they've received the online return late. If they never receive it, then they're not going to be able to see that it is late until they follow up the fact that there has been a disposal. But in a situation where there is no tax liability, provided that it's a disposal of a dwelling in the UK by a UK resident, which it is here, the online return is not required. So where at the date of disposal in the tax year, we can see that the gain would be covered fully by the annual exemption, or perhaps by losses already realised in that tax year, then you're forgiven the requirement to complete the online return. You do, of course, have to give full details, as the original poster has said, on the self-assessment return for the year, but that's not a problem. One of the posters makes the very important point that this treatment does not apply in the same way for a non-resident disposing of a UK dwelling. The non-resident is still required to complete the online return, even if there is no liability. So that is an important distinction between the advice you would give a UK resident client and the advice you would give a non-UK resident client on exactly the same transaction.
But the key point is no capital gains tax, no return. That is the message as long as the person is UK resident. Hopefully useful to both of the posters and also lots of other people besides. Tim and I will be back in around about a month's time to look at 2 more questions, possibly your question. Until then, bye-bye.